If you have a 401k or you like to buy index funds, you should probably know that a lot of your money is going into AI, whether you like it or not. That's because today, about 40% of every dollar that you put into a basic S&P 500 fund, 40% of that dollar goes to just 10 companies. Those companies are NVIDIA, Microsoft, Apple, Alphabet, Amazon, Broadcom, Meta, Tesla, Berkshire Hathaway, and JP Morgan. In fact, right now, as of this week, NVIDIA by itself gets almost 8% of every dollar. Now, that's gotten investors very excited about the future of how AI is gonna, change our lives. And it's also why their stock values have gone way up this year. And they've been able to spend a lot of money because of it. In 2025, those AI tech companies are gonna spend roughly $330 billion to build things like data centers, GPU farms, and all the stuff that they need for AI. But here's the part that's interesting. In order for AI companies to justify their valuations, in other words, what the price of their stock is today, those companies would need to make around $2 trillion a year in revenue. $2 trillion. To put that into perspective, in 2024, Apple, Amazon, Microsoft, Meta, NVIDIA, Google combined did not make $2 trillion. In other words, AI has already been priced as if it's going to become the biggest money-making engine in the history of capitalism, bigger than every major tech company today combined. That's kind of a major red flag. But it gets even better. Sam Altman from OpenAI just said that his company is willing to commit $1.4 trillion in spending to make all of this a reality. And someone at his presentation was like, I got a question. How are you going to pay that money when your company just made about $20 billion this year? To which Sam Altman kind of snapped. Then he says, the amount of money needed to build AI and make it profitable might only be possible if the government steps in and gets involved. So the market was like, wait, are you asking for a bailout? And he's like, no, I was just kidding. We don't need to do that. We can do this by ourselves. We don't need the money. So that's a red flag. And obviously, we are very far away from AI running our lives, but those are the expectations of the stock market. The reality is that they are not being paid for with profits, right? That's called free cash flow. Right now, those companies are all being funded with a ton of debt. And a huge part of that debt is not even showing up on their balance sheet. That debt is hidden. The spending is being run through things like private credit, structured vehicles called SPVs, joint ventures, and what's called circular financing. So what all of this does, though, is it makes the US economy look strong. It makes the stock market go up. But the risk is that it only looks strong because these companies are passing money around to each other in order to make it look bigger than it actually is. And for investors, that means for these companies to be as valuable as they are today, they have to be borrowing from a future that doesn't exist yet. Now, when you add all this up and you look at what some of the big investors have been doing, you might be worried. Warren Buffett, for example, just sold billions of dollars of stock, and he's now sitting on the biggest cash pile in the world. That doesn't look good. And Michael Burry, the guy who predicted the 2008 financial crisis, his fund, Scion, filed what's called a 13F form where it shows he's putting 80% of his portfolio betting against NVIDIA and Palantir. So all of this leads to the question, are we in an AI bubble? Data from Deutsche Bank says if it wasn't for AI spending right now, we'd be in a recession. So in today's video, I want to help explain everything that's happening to the market, what in the world is happening to Bitcoin, and what I'm doing with my money and how I'm investing. This is super interesting, so let's get into it. Now, I know it sounds a little silly, but what is a bubble? Most people say it's when the price of something goes above a sustainable value because of hype and greed. But what a bubble really is when the price of something goes up really fast with no relationship to its fundamentals. It's when nothing changes, but the price still goes up really fast. So let me explain the mechanics of how this AI machine is actually working, and then you can decide for yourself if it's a bubble. So in the AI economy, money or revenue is created through what's called circular financing. So at the center of this is the most valuable company in the world, NVIDIA. It's worth trillions and trillions of dollars because it's a way for the world to bet on the future of AI. So NVIDIA decides to invest into OpenAI, the people behind ChatGPT. So they're like, here's $100 billion, go build stuff. OpenAI is like, cool, we got $100 billion. So it then commits to huge cloud contracts with other companies like Oracle and Microsoft to run their models. Well, then Oracle and Microsoft are like, wow, look at all this demand that we have for our services. We're making money, right? Oracle then takes that demand and buys tens of billions of dollars of NVIDIA GPUs. NVIDIA's like, we're making money. And then NVIDIA agrees to invest more of that money back into OpenAI. So the money goes from NVIDIA to OpenAI, from OpenAI to Oracle, and then from Oracle right back to NVIDIA. It's the I owe you skit from the Three Stooges. It's a feedback loop where everyone looks like they're growing, even if the money they're spending was borrowed. Now you might be like, okay, I don't really care about this stuff because I'm not investing in this. Who cares if a bunch of rich tech investors lose their money? It doesn't really concern me. But it should actually concern everyone, because these kind of feedback loops is what creates a situation of too big to fail. If companies are allowed to represent such a huge part of the US economy, they must not be allowed to fail. Because to let them fail would be like letting a competing nation win. And the CEOs of these companies know that the US government will do anything and everything to make sure that we win the race against China. Like if you were CEO and you knew how strategically important your industry was, wouldn't you do everything in your power to get as big as possible so that the government takes a strategic interest in you? Because if AI CapEx, as they call it, by the way, CapEx stands for capital expenditures. Anytime you hear CapEx, just remember spending. If AI CapEx slows down, the US economy slows down. If the US economy slows down, markets fall. If markets fall, there's going to be political pressure to save these companies at all costs, because if not, it's going to hurt everyone, not just investors, but the jobs, the employees, and the country's interest as well. That's why Sam can say something like that out loud, because it's true. The US government cannot and will not allow this race of AI to just be lost. Now, what all of this means is that the bigger AI gets, the more all of us are involved in it. And the more likely taxpayers will have to eventually backstop it if something were to go wrong. Even if you're someone who doesn't really care about AI, you probably still have a huge financial interest in it. Why? Because of how an index works. It works because the S&P 500 index is what's called a market cap weighted index. Remember, the market cap is just the amount of shares multiplied by a company's price. That means the more expensive a stock becomes, the bigger the company gets, and the more it moves up that index because the market cap grows bigger. That's why it's a market cap weighted index. And as it gets bigger, it attracts more and more money. And that is how just the top 5 companies out of 495 represent 30% of the whole index right now. So when you combine the circular funding mechanism with how the index works, you start to see how it all comes together, right? Money gets passed around via the circular financing, so no real value is created. The price of a stock goes up really fast, and those participating in this feedback loop get bigger and bigger, so more money is allocated to them through passive investing, and now they've got more money to continue making these commitments, which adds to their valuation, and so on and so forth.